Welcome to the Tesla Economist. Please hit the thumbs up and don't forget to subscribe. ARK Invest's latest Big Ideas report for 2021 has just been released. I wanted to go through the parts that could affect Tesla. Deep learning is a form of artificial intelligence that uses data to write software. This would essentially automate the creation of software, which would have an incredible impact on every industry. ARK says this will add a further $30 trillion to the global equity market capitalization over the next 15 to 20 years. Self-driving cars are one of the applications for this, and for some reason they use Google's Waymo as an example. Waymo's autonomous vehicles have collected more than 20 million real-world driving miles across 25 cities, including San Francisco, Detroit, and Phoenix. Whereas Tesla must be over about 5 billion miles collected now, so strange example for them to use, considering they have a large holding in Tesla. ARK says that although hardware and software is improving and reducing AI training by 37% a year, the AI models themselves are growing by 10 times a year, meaning that they need vastly more powerful machines for this application, and the cost will go 100-fold over by 2025, from AI training models costing $1 million today to more than $100 million by 2025. As these costs grow, specialized GPUs and TPUs will account for the majority of the growth. ARK estimates that data center spending on AI processors will scale more than fourfold during the next 5 years, from $5 billion today to $22 billion in 2025. Electric vehicles are approaching sticker price parity with gas-powered cars. Leaders in the EV market are developing innovative battery designs to enable longer-range vehicles at lower costs. Based on Wright's law, ARK forecasts that EV sales should increase roughly 20-fold from 2.2 million in 2020 to 40 million units in 2025. They believe the biggest downside risk to their forecast is whether traditional automakers can transition successfully to electric and autonomous vehicles. I don't quite know what ARK means by risk here, but this could be inferred, according to their research, that the traditional automakers don't seem to have proven that they have a chance of making it just yet. Electrical vehicle sales have been improving during COVID, whereas gas-powered have been falling. ARK then bring out a graph for Wright's law. For every cumulative doubling of units produced, battery cell costs will fall by 28%. The largest cost component of an EV is its battery, so these cost declines are critical to reaching price parity with gas-powered vehicles. So wow, and given that Tesla is likely to jump from 500,000 last year to over 1 million cars this year and probably 2 million the next year, that would be a drop of 28% in battery costs each year. And that would be if Tesla were the only ones making the batteries. So battery costs will plummet compared to where they are today. This is also on lithium-ion decline model. We could always see new types of batteries that create a further step change, like graphene. Electric vehicles are approaching sticker price parity with gas-powered cars. The total cost of ownership for a like-to-like EV dropped below that of a Toyota Camry in 2019. Soon, sticker prices will likely do the same. Due to the low running costs of Teslas, they have such a high intrinsic value that when we have a $25,000 Model 2, they won't only have dropped below the cost of ownership, they would have dropped below the cost if Toyota gave them away over a 5-year ownership period. In addition to cost, EVs are competing on range and performance. The auto market is undergoing a shift to both electric and autonomous. ARK believes that traditional automakers lack the software and electrical engineering talent necessary to succeed. I'm going to assume the Model S was on here too, but must have been literally off the charts. Either that or ARK are just trying not to give Tesla all the credit and act objectively. Yes, I believe they also won't succeed. In addition to that, I can see them investing billions into trying to catch up with Tesla. Only Tesla out-innovate them again, and they're stuck with their antiquated billions invested. They only have so many lifelines until they go bankrupt. At today's battery prices, cell-to-vehicle technology enables longer-range EVs at lower prices. So to translate, Tesla are the only company doing cell-to-vehicle. Even NIO announced their new car that comes out in about 2 years' time, and it still doesn't have it. And we expect to see the Model S with it in the earnings call. Cell-to-vehicle designs increase the volumetric density of batteries by 50% relative to battery cell integration into modules and packs. In the mass market segment, cell-to-vehicle technology should enable EV makers to lower energy density and cost cells, producing more kilowatt hours to increase the range of vehicles. At a given battery pack size, cell-to-vehicle technology should enable longer range vehicles at lower price points. So this is what Tesla announced on Battery Day, how the structure of the car will serve as the battery pack. So in case you aren't catching this, the chart that says battery as percent of volumetric density compares cell to module pack with the cell to pack vehicle, with 40% to 60%. In other words, Tesla's cell to vehicle design alone is 50% more efficient. And by 2025, they're expecting 40 million EVs. So how many companies do you see at the moment gearing themselves up to make that many EVs? It doesn't matter how many factories the likes of Volkswagen have if they can't get the batteries. This is more about demand than supply anyway. Essentially, Tesla aren't going to have any trouble selling any cars. ARK expects that sales of smaller, cheaper neighbourhood electric vehicles will rise dramatically as a share of total EV sales. Translation, the Tesla Model 2 will absolutely kill. Autonomous ride-hailing is likely to dominate urban transport. ARK believe autonomous ride-hailing will reduce the cost of mobility to 1/10 the average cost of a taxi today, spurring widespread adoption. ARK's research suggests that autonomous ride-hailing platforms will generate more than $1 trillion in profits per year by 2030. In addition, automakers and fleet owners could enjoy profits of $250 billion and $70 billion respectively. Just some quick numbers. If Tesla are at $1 trillion a year profit with a PE ratio of 30, then that's a $30 trillion valuation. But I don't entirely agree here. I think that the fleet owners will be taking more income than Tesla, as they also have to pay for their initial vehicle, and they will be doing all the maintenance work too. But I also believe the industry is bigger than that. Tesla have beaten all of ARK's previous estimates, so I believe this one to be somewhat pessimistic, if anything. On the other hand, these analysts are probably more credible than me. Autonomous ride-hailing is likely to be affordable. Adjusted for inflation, the cost to own and operate a personal car has not changed since the Model T rolled off the first assembly line. ARK estimates that, at scale, autonomous taxis will cost consumers 25 cents a mile, spurring widespread adoption. Again, it all creates deflation in the economy. Robotaxis should expand the ride-hailing market. I'm not sure why they say should. I assume it definitely will. According to ARK's research, the ride-hailing market today generates roughly $150 billion in revenues globally, with take rates of 10 to 30% and profit margins as high as 50% in high-performing cities. Likewise, autonomous ride-hailing could generate 50% margins, but its lower price point should expand the total market from $150 billion in revenue, with take rates up to 60% to $6 to $7 trillion by 2030. So now they're saying revenues will be at 6 to 7 trillion, which is more what I agree with, but they said previously profits are only 1 trillion. I'm not sure why they think autonomous ride-hailing would have such low profit margins. To me, that doesn't quite add up. Maybe I'm missing something here. 3 autonomous strategies are evolving. Tesla's approach is camera-based, with less accurate sensors than LiDAR, making the path to full autonomy a more difficult problem to solve. Cameras do not rely on HD maps and should enable a much more scalable service. Tesla's could be the first autonomous taxi network to scale nationally. So they're saying because Tesla's system doesn't need to map out the entire world with LiDAR, it can be used anywhere instantly. So we'll have total first movers advantage with the autonomous ride sharing. This is major. Alphabet's Waymo is using LiDAR and HD mapping. Waymo launched its autonomous network in Arizona, but probably will need time and significant resources to scale nationally. Many Chinese players, including Baidu's Apollo, are building out infrastructure sensors to help vehicles identify road signs and traffic, requiring large infrastructure investments. This approach to autonomous ride-hailing seems to be the most rigid and least scalable of the 3. Of course, let's not forget that Tesla, in a sense, are also able to bring out their own infrastructure designed for autonomous cars, with the Boring Company. Okay, Tesla doesn't own it, but since Elon does, I'm sure Tesla will. Scalability will determine the pace of autonomous ride-hailing adoption. If Tesla launches its autonomous ride-hailing service successfully in 2022, ARK estimates adoption could approach 20% by 2025. If Waymo or GM is successful, adoption probably will be limited to 1% during the next 5 years. Yes, first mover advantage is the biggest advantage here. Demand response could be higher in developed versus developing countries. We believe autonomous ride-hailing will undercut the cost of human-driven ride-hailing by roughly 90% in the US and 50% in China. As a result, the demand response to inexpensive autonomous travel could be higher in developed countries than in developing countries. Platform providers or companies that own the autonomous technology stack should garner the lion's share of autonomous ride-hailing profits. Because labour is more expensive in developed countries, in contrast to the vehicle, when you remove the driver, it's a bigger percentage reduction of cost in developed countries. ARK believes that autonomous ride-hailing platforms could generate more than $1 trillion in operating earnings annually by 2030. Auto manufacturers with successful electric vehicle platforms partnered with autonomous technology providers could generate roughly $250 billion in earnings annually by 2030. Fleet owners that own, house, and maintain autonomous ride-hailing vehicles could generate roughly $70 billion in earnings annually by 2030. Enterprise value for autonomous platform operators could scale to $3.8 trillion by 2025. In other words, Tesla's Robotaxi business alone will be worth trillions in a few years. This report is very exciting. There's lots of other interesting facets to it as well. I suggest you have a read. I've included a link in the description below. Thanks for listening. Please hit the thumbs up and don't forget to subscribe.